The Italian economy, renowned for its rich cultural heritage and iconic landmarks, has been grappling with a multitude of problems over the past decade. Despite its resilience in the face of adversity, experts are now warning that Italy's great economy is on the brink of collapse. With mounting debt, political instability, and a pandemic-induced economic showdown, the country may soon face a financial crisis that will have far-reaching consequences for Italy and the entire European Union. In this episode, we will explore the factors that have led to Italy's economic downturn and what the future may hold for this once great economic power. How did Italy become the 8th largest economy in the world? Italy is a country with a fascinating history that spans centuries. Located in the heart of the Mediterranean, Italy has been a major economic power since the Middle Ages and Renaissance. Thanks to its strategic location and access to major trading routes, during the 20th century, Italy's economy experienced significant growth, driven by its strong manufacturing sector. The country has become renowned for producing high-quality goods such as fashion, cars, and machinery in high demand worldwide. In addition to its manufacturing prowess, Italy is also home to a thriving tourism industry, attracting millions of visitors annually. From Rome's ancient ruins to Venice's beautiful canals, Italy is a country full of rich cultural heritage and natural beauty. Furthermore, Italy's agricultural sector is also a significant contributor to its economy. The country is the world's largest producer of wine and olive oil, and is also renowned for its production of pasta, cheese, and other culinary delights. Despite facing some economic challenges in recent years, Italy remains one of the world's largest economies and a prominent player in global markets. With a rich history, diverse economy, and stunning natural beauty, Italy is a country that continues to capture the imagination of people around the world. Unexpected external factors have severely impacted the Italian economy. Do you know what's remarkable about the Italian economy from the 1950s to the 1990s? It's how robust it was despite being the poorest member of the European Economic Community when it was established in 1957. But Italy had a secret weapon, a long tradition of high-quality manufacturing in the north. Italy became the bloc's lowest-cost maker of a host of goods, from cars to refrigerators and washing machines. And with the migration of farm employees to higher productivity manufacturing and services, growth was boosted. By 1987, Italy proudly celebrated overtaking Britain in real GDP per head. Quite impressive, isn't it? Catching up with others is more accessible than leading the pack. Italy was once a net receiver of EU funds, but by the late 1990s, it was no longer. Its unit labor costs had increased and exceeded the bloc's average. With a history of low investment, a relatively small capital stock, high public debt, and a much reduced agricultural sector, Italy needed help to maintain the high productivity growth it had achieved in the 1960s and 1970s. Previous advantages, such as Italy's private small family-owned firms, began to appear as disadvantages. Then, Italy managed to enter the European single currency, the euro, in 1999, despite facing difficulties meeting the convergence criteria set by the 1992 Maastricht Treaty. Germany designed the criteria to keep out a profligate, chronically indebted Italy. However, Spain's determination to join the bloc and Belgium's public debt above 100% of GDP helped Italy's cause. Italian Prime Minister Romano Prodi also introduced a special euro tax to meet the convergence criteria. Italy needed to adopt a new model to remain competitive inside the single currency, making supply-side reforms that would reduce its unit labor costs compared to Germany's. However, under Silvio Berlusconi's government from 2001 to 2006, Italy allowed labor and other costs to rise as much as before, resulting in a steady loss of competitiveness against other Eurozone countries, especially Germany. Moreover, China's accession to the World Trade Organization in 2001 and the enlargement of the EU to include Central and East European countries in 2004 significantly impacted Italy's manufacturing sector. The financial crash of 2007 to 2009 and the Eurozone's sovereign debt crisis also hit Italy's economy hard. In recent times, Italy has suffered significantly from the arrival of COVID-19 in early 2020 and the Russian invasion of Ukraine, which led to a sharp rise in energy costs this year. Overall, Italy tends to suffer more than its neighbors in the face of external economic shocks. Italy's monetary and fiscal policies were too high, rather than to lose, for much of the first 2 decades of the euro. This contributed to the country's main weakness, a lack of growth resulting in stagnant wages and living standards. The Italian public has felt the impact, with public services being underfunded and the country's southern region suffering significantly. As a result, public opinion has shifted away from its previous unwavering support for the EU project, which is one of the reasons for the electoral success of Miss Melanie's coalition. The economic climate in the Eurozone has improved, but severe inflation and rising interest rates pose new challenges for Italy. The country will face a baptism of fire over the economy. Italy's structural impediments to growth continue to afflict the economy, and some believe that the EU should not intimidate Italy into excessive austerity or unpopular reform. Low productivity. Low productivity is one of the leading factors behind Italy's economic crisis. Despite being one of the world's largest economies, Italy's productivity levels have remained stagnant for several years now. This means that the country produces less output per worker than it is, which directly impacts economic growth. Low productivity can be attributed to several factors, including an inefficient bureaucracy, high taxes, and a lack of investment in research and development. Additionally, Italy's labor market has been characterized by rigid regulations and a large informal sector, hindering job creations and contributing to low productivity levels. Addressing these issues will be crucial if Italy is to return to its economic fortunes around and avoid a financial crisis. Low debt. High debt is a major concern and a reason for an economic crisis in Italy because it makes the country vulnerable to economic shocks and increases the cost of borrowing. Italy has one of the world's highest levels of public debt, with a debt-to-GDP ratio of over 150%. This means that the government spends a significant portion of its budget on servicing its debt, which leaves less money for other vital areas such as healthcare, education, and infrastructure. Furthermore, high levels of debt can scare off investors and increase borrowing costs, leading to a vicious cycle of debt accumulation. As a result, Italy's economy has been struggling for years, with low growth, high unemployment, and a lack of competitiveness. To address this issue, the Italian government has been implementing various measures to reduce its debt levels, such as reducing public spending, increasing taxes, and promoting economic growth. However, more than these efforts are needed to reverse the country's economic decline. What can Italy do to stop this crisis? Italy has been facing an economic crisis for quite some time now. The country has been struggling with high unemployment rates, low economic growth, and high public debt. Italy needs to take several steps to stop this downfall and come out of the economic crisis. Firstly, Italy needs to focus on increasing its economic growth. The country can invest in infrastructure, education, and research and development. This will not only create jobs but also attract foreign investments, which will further boost the economy. The government can also provide tax incentives to companies that invest in research and development. Secondly, Italy needs to address its high public debt. The country's debt-to-GDP ratio is one of the highest in the world. The government needs to implement measures to reduce its public debt. This can be done by reducing government spending, increasing taxes, and selling state-owned assets. Thirdly, Italy needs to tackle its high unemployment rates. The government can create more job opportunities by investing in tourism, renewable energy, and digital technology sectors. The government can also provide incentives to companies that hire unemployed workers. Fourthly, Italy needs to address corruption and bureaucratic inefficiency. This is a significant obstacle to economic growth and foreign investment. The government needs to implement measures to reduce corruption and streamline bureaucracy. Lastly, Italy needs to focus on attracting foreign investment. The government can do this by providing incentives to foreign companies that invest in Italy. The government can also create a more business-friendly environment by reducing bureaucracy and simplifying regulations. Italy must focus on increasing economic growth, reducing public debt, tackling unemployment, addressing corruption and bureaucratic inefficiency, and attracting foreign investment. These steps allow Italy to turn its economy around and emerge from from the economic crisis. As one of the largest economies in the European Union, Italy has been a critical player in the region's economic landscape for many years. However, recent reports suggest that the country's economy is on the brink of collapse. With a potential crash looming on the horizon, the reasons behind this impending crisis are complex and multifaceted. Still, analysts point out factors such as high levels of debt, a sluggish growth rate, and political instability as key contributors. Despite those challenges, Italy has opportunities to turn things around and emerge from this crisis more assertive than before. With the right policies and strategies in place, it may be possible to stabilize the country and economy and also set it on a path to sustainable growth. However, time is of the essence, and bold action will be needed to prevent a collapse and ensure as well a brighter future for Italy's citizens.